Just because a lender said you can buy a home for 700,000 doesn't necessarily mean you should. And just because Zillow says you can afford a $500,000 home doesn't mean that needs to be your limit. Let's show you what actually determines how much you can afford. So the biggest myth in home buying is that affordability is based on your income alone. It's not. Lenders look at your income, your debt, your credit score, your down payment, interest rates, taxes, homeowners insurance, mortgage insurance, homeowners association dues, and even the type of loan you're using, and in some cases, even the type of home you're purchasing. So let's break this down a little bit. So income is one of the number one factors, and the more income you have, the more home you generally can afford. But income alone doesn't tell the whole story. So, factor number two is going to be debt. And this is where buyers lose most of their buying power. Some examples of monthly debt are going to be a car payment, let's say of like $800 a month, or $250 a month in credit card debt, or $300 a month in student loans. Those payments reduce what can be allocated towards a mortgage. So, factor number three is interest rates. A 1% change in interest rates can dramatically impact your buying power. A buyer qualifying for a $500,000 home at one rate may qualify for $10,000 less. If the rate rises, the payment matters more than the price tag. So, the fourth factor is going to be down payment. So, more money down doesn't just lower your payment, sometimes it helps you qualify for a larger home. Some loan programs offer as little as zero down, whereas others start at like 3 or 3.5% down. But making a larger down payment of like 5 or 10 or even 20% down can reduce the mortgage insurance or maybe even remove the mortgage insurance. So let's compare two different buyers. So buyer has $120,000 in income and $250 in monthly debt with a 740 credit score, potentially qualifying for a significantly larger home. Buyer B's income is $120,000 but $1,500 in monthly debt, but much lower purchasing power. Same income but very different outcome. Instead of asking how much I can afford, what I would ask myself is what is my comfortable monthly payments? I'd rather help a family buy a home comfortably than to stretch every dollar just because technically they qualify. So, some of the common mistakes that buyers make is shopping before they get pre approved, assuming that 20% down is a required down payment, using online calculators without calculating in the taxes, homeowners insurance, forgetting about homeowners association dues or mortgage insurance, and focusing on only one rate. And also maybe looking for the maximum approval instead of a comfortable payment. The best way to find out how much a house you can afford isn't by using an online calculator, is by having a conversation with the lender who can look at your complete financial picture. And sometimes buyers qualify for more than they think, and sometimes they qualify for less. Either way, it's better to know before you start shopping.